What if I told you that thousands of Indians, salaried employees, freelancers, business owners, are legally paying zero income tax every single year? And it has nothing to do with hiding money or fake bills. It's all completely above board. And the government actually wants you to use these methods. The problem? Most people never find out about them. Not because the information is secret, but because nobody bothers to explain it without charging you a consultation fee. Today, that changes. By the end of this video, you'll know exactly how to reduce your taxable income, legally, officially, using rules that are already written into the Income Tax Act. Whether you earn 5 lakh or 25 lakh a year, there is something in this video for you. Stay till the end, because the last strategy is one most people completely overlook, and it could save you 50,000 rupees or more every year. Most people think paying tax is unavoidable. You earn money, the government takes a cut. End of story. But here's what the Income Tax Act actually says. You are only required to pay tax on your taxable income, not your total income. These are two completely different numbers. Your total income is everything you earn. Your taxable income is what's left after you subtract all the deductions and exemptions the government legally allows you to claim. The difference between these two numbers? That's where most Indians are losing thousands of rupees every year, not because they're doing anything wrong, but simply because they don't know what they're allowed to deduct. Let's go through the biggest ones. The most powerful tool available to every Indian taxpayer is Section 80C. Under this section, you can reduce your taxable income by up to 1.5 lakh per year just by putting your money into certain approved investments. Here's what qualifies. EPF, your Employee Provident Fund contribution, already counts. Most salaried people are already doing this without realizing it's saving them tax. PPF, the Public Provident Fund. You invest, it grows tax-free, and the maturity amount is also tax-free. Triple Benefit, ELSS mutual funds, equity-linked savings schemes. These are mutual funds with a 3-year lock-in that also give you 80C benefits. Best part, your money actually grows at market-linked returns. Life insurance premiums, home loan principal repayment, children's tuition fees, all of these count under 80C too. If you're in the 30% tax bracket and you fully use 80C, you save 46,800 rupees in tax every single year, just by redirecting money you were going to spend or invest anyway. Section 80D lets you deduct the premium you pay for health insurance. Here's how it breaks down. Up to 25,000 for health insurance for yourself, your spouse, and your children. An additional 25,000 if you're paying for your parents' health insurance, and if your parents are senior citizens, that limit goes up to 50,000. So a person who covers their own family and their senior citizen parents can claim up to 75,000 in deductions under 80D alone. And here's the thing, you need health insurance anyway. Medical costs in India are rising every year. Getting this deduction is just a bonus on top of something you should already have. If you're salaried and you pay rent, you are sitting on a deduction that most people don't claim correctly. House rent allowance, HRA, is partially or fully exempt from tax. The exact amount depends on 3 factors. The HRA your employer actually pays you, 50% of your basic salary if you live in a metro city, or 40% if you live anywhere else, and the actual rent. You pay minus 10% of your basic salary. You get the lowest of these 3 as your exemption. Now here's the hack that most people miss. You can pay rent to your parents. Legally, if you live with your parents and pay them rent, you can claim HRA exemption on that rent, and your parents can show it as rental income, which, for most retired parents in lower tax brackets, gets taxed very little or not at all. Your tax bill goes down. The family keeps the money. Everyone wins. If you have a home loan, the government is practically paying you to have one. Under Section 24B, you can deduct up to 2 lakh per year on the interest you pay on your home loan. Under Section 80C, you can deduct up to 1.5 lakh on the principal repayment, which is part of the same 80C limit we discussed earlier. So a home loan gives you deductions on both the interest and the principal. Combined, that's up to 3.5 lakh in deductions from a single loan. If you're buying a home, this should absolutely factor into your decision. The tax savings alone can significantly reduce the effective cost of your EMI. See you in the next video.